Hi guys, so I'm going to explain the 4 ICT concepts that I use for my trading model. So the first one will be liquidity. So what I want to see before I trade, right? It's to see that on these timings, either one of these timings, 9:30 p.m. market, NY market open, 10 p.m., 11 p.m. or 12 a.m. But most of the time I'm done between these two timings already. So what I want to see on 9:30 p.m. is liquidity to be swept. So over here you can see you got liquidity over here, and we got liquidity over here. And some of you may also identify this as accumulation. So this also counts as accumulation. So what I want to see New York to do is I want to see New York taking out these lows, because that means that a lot of people put their sell orders here, so they're expecting to go down, so they stop people out. Then they also manipulate and then make people think that it's gonna go down, so a lot of people put sell orders here also. So what I want to see is a manipulation. So they're gonna take out this liquidity zone, and then after that I want to see it come back, then form an SMT and IFVG here also, then come back, and then we target opposing liquidity as take profit 1, and then maybe previous day highs as take profit 2. So I'm going to explain what IFVG and SMT means. So SMT, what I want to see is the reason why I have two different charts, one Nasdaq and one ES, is ES is US 500. So the concept basically is that one of these indexes, since they're the same ones, right? If they show something else, so let's say ES takes out these lows and then it forms this, but then it takes out these lows and then goes higher. So this is basically an SMT where ES takes out these lows and makes a lower low, but then on Nasdaq over here it doesn't take out that low. This is basically an SMT. If you see this, that means an SMT has formed. So after I see an SMT, right, I'm going to see that there's going to be a gap somewhere over here. This will be an inverse fair value gap that I'm going to enter off of. So the two differences between fair value gaps and inverse fair value gaps is fair value gaps is that they make a gap, right, and then most of the time it'll follow through. So that is the concept of fair value gaps. But then for inverse fair value gaps, what I want to see is price to make a gap, but then it's going to disrespect it. That is an inverse fair value gap. So over here, I'm going to draw the same gap over here. Fair value gap, right? It comes back to test that gap again. It's supposed to go down, but it doesn't. It actually disrespects this gap. So people call it inverse fair value gap. And then what people do is either some people will enter off of the candle close, the 1 minute body candle close above this gap, or some people will wait for a retracement onto that gap. For me, I will enter off of that close, because that means price is going to change aggressively already. Because once you have liquidity sweep and SMT and IVG, there's three confluences already based on the 4 steps. So this is the two differences between FVG and IFVG. FVG respects the gap, but IFVG disrespects the gap. So after all these happens, I'm going to take my entry off of this fair value gap, and then I'm going to put my stop loss on this protected low. Why is it called protected low? Because SMT tells us that S&P took this low, but Nasdaq didn't. So that means this is a respected low, and then I can target my take profit 1 at opposing liquidity, because New York took sell side liquidity, so it has yet to take buy side. So once we enter our buys, we're expecting New York to take out these highs, and then after that, if you're more aggressive, you can take out these highs also. But most of the time I just target a 1-to-2 risk to reward ratio. So I'm going to show you some examples of different trades. So here we can see liquidity being taken out over here. Wait, let me draw. Okay, now I just circle. Liquidity got taken out here on 10 p.m. macro timing. So that means liquidity has been taken here to go up higher. So what I wait now is an SMT. So over here you can see that Nasdaq took these lows, but ES didn't, and then bounced back up. And then there's a inverse fair value gap here, where since it inversed, I just enter a buy, and then for here I could have targeted over here. If you targeted here, you would have won also. But I just targeted a 1-to-2 risk to reward ratio, because that's enough for me. So first we got liquidity taken out over here, and then we got SMT forming, and then we have IFVG, you enter off of the disrespect, and then you put your stop loss on the protected low, and then you target 1 to 2, or you can target liquidity over here or liquidity over here. So another example is over here. Wait, is this the same? Oh yeah, it's the same trade, sorry. Wait, is this the same? No, it's not the same trade. Okay, so we got liquidity getting taken out over here, over here, over here. And this was on 10 p.m. Not 10 p.m. On around New York Open, the first few 15 minutes. So you can see it form an SMT where Nasdaq took out these lows, but ES didn't. So ES formed the higher low, but Nasdaq formed the lower low. So that basically is an indication of a reversal. So then we found a fair value gap to enter off. Then if you enter, right, I think got example, you enter off of the disrespect, and then you target these highs over here. You would have won. Then over here is we took these liquidity zones over here, all this liquidity when New York opened also. So this was, I think, exactly, yeah, around 9 pre-market, almost New York open, but we took these liquidity zones, and then after that we formed an SMT. Then there's a CISD over here, and then if you enter off of a sell, you could have won if you target London lows. Oh yeah, so CISD basically means change of character. It's another word for change of character. So basically, let's say we got okay, this one I have to find live example. Okay, let's just use today as an example. So CISD basically means after a series of, I'm gonna do a bullish example. After a series of bearish candles, so let's say this is a bearish candle over here. After a series of bearish candles, you can see that price on 1 minute time frame made a higher high, then made a lower high, then made a lower low, then made a lower high, then made a lower low. And after that, we can see that price broke this lower high and then formed a higher high. So that is a CISD, or in other words, also a change of character. So what some people will do is they will either wait for a candle close above the CISD, then they enter off of the next candle. Some people will also wait for retest, but in this case here, it didn't retest. But in this case, I enter off of a IVG, which I'll explain later also. So that's how a CISD works, and then IFVG, and then liquidity, and SMT. So yeah, so let's look at today's example. So today's example was quite textbook. Okay, because we had New York open, and then it just dumped and took these liquidity zones over here, and over here. So once they take all these zones already, a lot of people will be selling here. So what you want to do is don't panic. You just wait for them to take liquidity. Then you wait for them to form something, and then you enter. So we got all these liquidity getting taken out. But then what we saw today was an SMT over here on the 5-minute time frame. We got here. There's a higher low over here, but Nasdaq didn't take this low, so it made a higher low, right? So like this. But then we see ES, S&P, it didn't take it took this low, barely took this low, but it still took this low. So there's an indication of reversal. So after that, hop on the 1 minute to look for areas to enter off of. So after that, we can see over here a really small gap you can enter off of. So I waited for the candle close to mark the disrespect of the gap, because sometimes what you'll do is sometimes you can do this, and then before it closes, right, you come back down here, then it's technically also respecting the gap. So sometimes, actually, yeah, no, most of the time I'll wait for candle close, and then wait for retest. I entered over here, and then I targeted liquidity over here. So I entered here, stop loss at the protected low, and then target liquidity over here. Then you can look for areas to break even your trade also. So at this high, this is where I broke even for my trade, and then I'll just let it run. It's a 1 to 2. So that's it.